So when we are looking at investments, we evaluate them from the lens of six criteria. So one is appreciation, pretty easy. How much does my investment increase in value? Two is cash flow. How much is this investment paying me on a regular basis, whether it's monthly or quarterly? Three is tax benefits. What kind of tax benefits is this investment giving me? Four is risk, right? How risky of an investment is this? Five is liquidity. How easy is it for me if I want to sell and get my money back? How easy is it to do that? And then six is a charitable or impact investing, right? Altruistic investing. Those are the criteria that we look at investments from. So the stock market, if we were to evaluate it at the using the six criteria, the stock market compound like appreciates at 10% a year, right? Typically that's your average growth. So that's one. Number one. Two, for cash flow in the stock market, that's the equivalent of dividends. Usually you're going to get 3 to 4% in dividends in the stock market, as far as I've seen.
Yeah.
And if you do get really high dividends, that's usually comes at the loss of appreciation. You really have to pick one or the other. Third, tax benefits. The stock market, it has capital gains tax and qualified business income, I believe, or dividends, where dividends get taxed as capital gains. Beyond that, not much. Risk, and I'll say risk slash volatility. We've seen how volatile the stock market can be. A few weeks ago, when
Right.
the market was freaking out over DeepSeek, I think Nvidia lost hundreds of billions of dollars in a matter
Yeah.
of a couple of days. And more broadly, close to $1 trillion at some point was wiped out from the stock market, US stock market. So things like that, at the push of a button, investors, algorithms can panic buy, panic sell. We saw what happened with GameStop too, right? A few years ago,
hmm
where there were no fundamentals and it was just pushed up on a fear of on FOMO and emotions. In my opinion, in that regard, it's a step above, at best, one step above a casino. Beyond that, liquidity, that is one thing I'll give the stock market. It's pretty easy to buy and sell. And that's, people might consider that a pro. I consider that a con, honestly, because that promotes that monkey behavior of buying when everyone else is buying, which is usually when the price is high, and then selling when everyone else is selling, or when you feel like you should be selling, which is when the price is low. Right? Panic buy, panic
Right.
sell. And lastly, charitable. I don't know where the stock market ranks on that. Now, private equity, on the other hand, again, going through the six criteria, we typically conservatively target a 15 to 30% return on our investments. You might think that's crazy to those of you listening at home, but every investment that we put out, we share with you what the financial modeling is of the investment that we're making. Also, especially, at least this is the case in real estate, the biggest investor in a deal is never you. It's almost always the bank. And maybe in 2008, banks were really lenient and you could have questioned their underwriting practices, but since then, they've really cleaned up. So 60 to 70% of our capital that we raise from quote unquote investors is from the bank. So if a bank is willing to back 60 to 70% of it, then you should feel fairly comfortable that, hey, this is a somewhat legitimate investment. Not saying that's the only check you should be performing, but I'm just saying that it's not completely crazy to think that there are investments out there returning 15 to 30%. I think it's
Right.
arrogant, honestly, to think that your investment portfolio is the best one out there and to not even consider the fact that someone else is outperforming you, right? And if someone else is outperforming you, how are they outperforming you? How much
hmm
and what are they doing? And for me, I just thought about it. There's no way the wealthy are just sitting there waiting 10% a year. In 50 years, I'll have something to retire and I'll be 70 by then. There's no way that they're waiting for that. They're doing something else. And syndications is part of what they're doing. So that's the returns on cash flow. We see anywhere between 5 to 20% cash flow, depending on the deal. Now you might say, hey, you said the stock market's 4%. Now you're saying 5 to 20%. That 5% cash flow, if it's that low, typically the deal has a lot more in appreciation. Again, when we combine our cash flow with how much we gain from appreciation over time, we typically achieve that 15 to 30% return range. Tax benefits, 0.3 tax benefits, and real estate are pretty great. They reduce the taxable income or defer the taxable income you have to pay on your investment. With oil and gas and likely other energy investments as well that we're looking at, and we can dive into this a little more, you not only have the ability to reduce your income or defer your income from your investments, you can actually reduce your W-2 income, taxable income. You can also reduce your taxable capital gains liability too. Fourth, risk. I would say again, real estate is a much safer asset class than the stock market. Oil and gas could be as risky as the stock market, but there's varying levels of it. But I'm saying that overall, you have assets, primarily real estate and private debt, private lending, that are safer than the stock market. And liquidity, I would say, is one place where some people might say private equity suffers because your money typically has to be locked up for at least 90 days and as long as 10 years. Again, on every opportunity that we present, we let investors know how long to expect to have their capital locked up for, but it's somewhere within that very wide range. And there's no free lunch, so you have to give some in order to get some. So in this case, you're giving up liquidity in exchange for higher returns, but also I think that's a boon if you have the patience to ride out market cycles. It teaches you to be a diligent investor and make decisions very wisely because you know that once you put this $50,000 down, it is really hard to get back. So you're going to do due diligence, you're going to become an expert at analyzing investments. And on the flip side, once you have made your investment, you won't sell just because of the slightest disturbance in the universe, right? You won't just sell because they dropped interest rates by whatever 25 basis points.